So welcome to our final energy webinar of 2014. There are many of you who know us quite well, but for those who don't, this is my name's Alexis Arthur. I'm Energy Policy Associate here at the Institute of the Americas in La Jolla, and this is our energy webinar series. And today we are very lucky to have Francisco Monaldi talking about oil prices and Venezuela's energy outlook. So just to start off, I'll go through how the webinar works, particularly for those who haven't sat in on our other webinars. And then we'll have some introductory remarks by Jeremy Martin, our Energy Program Director here at the Institute, followed by about a 20-minute presentation by Francisco Monaldi at the Harvard Kennedy School. And then we'll have an opportunity to do question and answer with Francisco online, and closing out at 12 o'clock San Diego time. So the whole thing will take about an hour. But let me just, for those who don't know how to ask questions, you can ask questions at any time, but I will be holding off on putting them to our presenter until we get to the Q&A session. But on the right-hand side of your screen, you'll notice a chat button, and you'll see some people have already started chatting to each other there. But under the chat, you'll see a little question mark. If you don't mind typing your question there, and what I will do is put the question on the screen so that everyone can see it, and Francisco will respond. And I'll be moderating the Q&A session, so please feel free to ask any question you like, but please keep it brief. The longer it is, the more difficult it is to fit it in the box on the screen. So that's probably it really from me, other than welcoming everybody again and thanking our sponsors, Intercap Energy Systems and Bates White Economic Consulting, and just reminding everybody that I will be tweeting as we go along from @IOA_energy. And please, this will be on the record, it will be recorded, the presentation will be made available afterwards. And if you would like to, I see a lot of press people, just remember to cite the Institute of the Americas as you go along. And thank you very much. Without further ado, Jeremy Martin.
Well, I want to thank Alexis because this is the last energy webinar of 2014 here at the Institute of the Americas. And Alexis has done a wonderful job, and for many of you, you've tuned in and dialed in to many of these throughout the year. And we've had quite the array of topics covering all kinds of issues that have popped up and continue to present themselves in terms of energy policy and energy issues facing our hemisphere. And so I want to congratulate and thank Alexis for all of her efforts throughout 2014. And of course, this will also be the perfect segue to invite many of you to consider joining us and supporting us a little bit more profoundly in 2015 as we ramp up our 2015 energy webinar series. So as Alexis reaches out to you and gets in touch, please let us know how you can support us in 2015 for our energy webinar series next year. But we are indeed fortunate, and I'm not going to belabor too much of the topic here, but I do want to formally introduce our speaker and presenter today, Francisco Monaldi. We are very fortunate to end the year on such an important topic. And when we chatted with Francisco about this topic, I think it was almost 2 months ago now, and oil prices were obviously trending down and presenting themselves as an important issue for energy in our hemisphere, and of course, given Francisco obvious area of expertise vis-a-vis Venezuela, I don't think I need to tell anyone online today how much more important and how much more relevant this topic has become in the intervening weeks. I know that the price, after Thanksgiving really took a drop, and now it's come back a tiny bit today. But the point is that the plummet of oil prices is critical for many countries in our hemisphere, but perhaps nowhere more so than Venezuela. And so we're pleased to invite Francisco today to speak. And Francisco, for those of you who may not know, he is currently the visiting professor of energy policy and Roy Family Senior Research Fellow of the Environment and Natural Resources Program and the Geopolitics of Energy Project at the Belfer Center for Science and International Affairs, which all of that is at the Harvard Kennedy School in Cambridge, Massachusetts, at Harvard. But many of you probably also know that Francisco is a full professor at ESA, the Instituto de Estudios Superiores de Administración in Caracas, and the founder and director of the ESA Center on Energy and the Environment. Francisco has a PhD in political science from Stanford, a master's degree from Yale, and a BA in economics from the Universidad Católica Andrés Bello. But I think the most important point is there perhaps is no one who is more conversant and more of a scholar on the politics and economics of oil and the oil industry and how countries manage oil wealth management in Latin America and particularly in Venezuela than Francisco Rinaldi. And so with that, Francisco, I invite you to unwind for us what all of this means in terms of oil price, but even without the oil price question, what all of this means for energy outlook, the energy outlook in Venezuela. Over to you, Francisco, and thanks everyone for joining us today.
Thank you, Jeremy. Very happy to be with you here. So basically, today I have a sort of a general presentation on how the oil industry in Venezuela is faring and what can we expect in the future, as you mentioned, in the midst of this significant price collapse. So the first thing that I wanted to show you is, this has been a spectacular decade for oil prices and for oil revenues in, of course, all oil exporters, but particularly in Venezuela. And here you can see that Venezuela received during the last 10 years a windfall equivalent to about 300% of GDP of additional revenues in oil, according to an IMF study. And this is significantly higher than any other country in the region. So in a region in which we had a spectacular commodity boom during the last decade, Venezuela was the best beneficiary. However, the results have been tremendously disappointing. Venezuela has had a very low growth rate on average in the last, say, 15 years. Actually among the lowest in the whole region. So the country with the best conditions had almost the worst economic performance. And of course, that if you combine the growth performance with the inflation rate, it's really puzzling to see how bad Venezuela fared compared to other, the rest of the region, but also compared to other oil exporters. So that is before we had this oil decline, and so that tells you a lot about what might go wrong afterwards, because if that was what's happening before, imagine now. So there was a tremendous tight connection between the popularity of both President Chavez and even initially President Maduro and the consumption boom that was provided by the oil boom. And you can see there how these two lines are really, really close. But recently, we don't have the latest figures for consumption, but clearly the popularity of President Maduro is collapsing, as probably with some significant relation with consumption. By the way, even though real expenditures by the government have kept increasing recently. So I will not go too much into the macro situation. I will basically go into discuss the oil industry, but just to mention a few sort of general figures. The government deficit will be by the end of this year at around 20% of GDP, and it's important that we talk about the deficit of the whole public sector and not just the regular budget of Venezuela, and that, of course, represents a significant increase from the deficit that the government had before the price started declining. Inflation probably will close at about 55%, probably closer to 70%, and next year most estimates are around 100 or more. The fiscal break-even. If you consider the very low, the very overvalued official exchange rate at which the government exchanges the petrodollars for bolivars, in fact, the fiscal break-even is huge. It's more than 170. However, that's not particularly relevant if you consider that the government can devalue and dramatically change that situation. And so with a major devaluation of, say, to 35 bolivars per dollar, the deficit will be still very large because of the decline in the price of oil, but will be much lower than the one we have now. the current account break-even of Venezuela is much lower than the fiscal break-even, but it's also, alarming because it's above what the current price is. And I mean, last week the Venezuelan basket closed at 62, and as we know, the oil has kept falling. So probably will close below 60 and this week. And the popularity of President Maduro has significantly declined to 24% from 51% that he had at the beginning. So that's the background that we have for the oil industry. And in general, if we look at the oil industry during the last decade, we have, that the private investment boom that we had in the previous decade, in the late 90s, early 2000s, allowed for an increase in production of about 1 million barrels from the privately operated projects or with private partners. But during the decade with the most favorable conditions, as I mentioned, in terms of prices, we have a very disappointing performance, a reality of decline and mismanagement in the oil industry, with production declining, subsidized domestic consumption increasing, export declining, significant subsidies to some partners of Venezuela. The cost of production have been increasing. The number of workers has been dramatically increasing. So a lot of things pointing in the wrong direction, and we will see that there are also some uncertainties about what might happen in the future. So in terms of resource base, the country has this amazing resource base, even though the quality, even though it's extra heavy oil and you need to either blend it or upgrade it in order to be able to export it. The quantities are staggering, and even though you might consider that the reserves that Venezuela reports are overstated because they use a very high recovery rate of 20% and not the one that actually has been attained, which is about 8%. Still, Venezuela would have, instead of the largest reserves in the world, the third largest or something like that. So the resource base is amazing, but as I mentioned, that hasn't been reflected in the production. So if you look at another measure, which is the reserves production ratio, Venezuela has 300 years of oil production, and if you compare to the OPEC countries and non-OPEC countries, it's again an extravagant figure. But as I said, those reserves are totally concentrated in extra heavy oil, and that requires very significant investment to be produced. So the reality of tremendous potential contrasts with the reality of decline. As I said, depending on the figures you use, from about 2007, we see a decline of about 600,000 barrels and close to 1 million from the peak in 97. Moreover, if you look at exports, Venezuela's decline is even higher than that because, of course, the domestic markets has been increasing. And so aside from Mexico, it's very rare to find a country in the world that has had a decline in production in the last 15 years, except for the North Sea countries that had a geological decline. So in addition to the production and export decline, you have the issue of the mix. The only area in which production is going up is the extra heavy in the Orinoco Belt, and the two traditional conventional areas of the country in the western Maracaibo Basin and in the eastern northern Monagas area are declining, and particularly worrisome is the decline in El Furrial and the fields in northern Monagas. And I will go to back that later. But the other of course issue that I already mentioned is the fact that we are subsidizing the markets of other countries, and in particular the cash flow of PDVSA. It's over about 1.5 million barrels instead of the 2.6 or 7 that it is producing. And the mix, it's the exports to the U.S. have declined to almost half of what they were less than 10 years ago, whereas the ones that are growing up are China, basically, I mean, Asia, particularly India and China. And of course, the legacy of the expropriations during the Chavez tenure are very significant. Venezuela is ranked as the worst country by the Fraser Institute Global Petroleum Survey in terms of investment barriers, and so the tremendous geological potential contrasts with this this problematic reputational legacy of lack of credibility by the government. Which is one of the biggest sources of lack of private investment. Then you have, of course, the lack of investment by PDVSA itself. I mean, the national company has been strapped from cash. The government extracts too much cash, either through the Fonden, I mean, the National Development Fund, the social misiones, social programs, the fact that PDVSA has to pay back the Chinese loans, and of course the domestic market and the Petrocaribe that I already mentioned. And so the trajectory of the debt of PDVSA has been a very significant increase from about $3 billion in 2006 to more than $43 billion today. And on top of that, you can add other the debt that partners and suppliers of PDVSA, that PDVSA has with partner suppliers. I mean, the arbitrations with Exxon and Conoco, that even though they have to be paid by the Republic and not by PDVSA, they are, very likely are going to be paid by PDVSA. And then you have this crazy phenomena of, because of the excessive overvaluation of the exchange rate, I mean, PDVSA has to be funded in bolivars by the central bank, which is one of the main sources of the very large inflation that the country has. And if you look at a sort of a measure of real investment, which is the actual number of rigs in operation in the country, you will see that they have not been going up significantly. They have been going up much less than the actual rate, the actual number of the real investment. So that is a worrisome sign that the investment, the necessary investments are not happening. Of course, as I mentioned, the production per employee has totally collapsed. PDVSA has about 30% less production than the peak, but it has something like 2.5 times more employees than it had before the oil strike. And the domestic market keeps growing because the gasoline is basically free, but on top of that, smuggling has been increasing significantly in the last few years, and you have a barrel of oil is sold inside Venezuela for about 1 cent per barrel, and the next country that has the largest subsidy in the world is Saudi Arabia, that sells it at $20 per barrel. So you are, you have a barrel of gasoline at say $75 being sold by 1 cent. So that's how crazy things are, and you can see here the evolution of the gasoline subsidy, that is really becoming, an amazingly high number. Of course, now with the declines in the oil price in the international market, the subsidies, the amount of subsidies will go down, but just because the international price went down, not because the gasoline has been increased. And of course, that is reflected, all the situation that I mentioned, in the fact that PDVSA does not fulfill its investment plans at all. In fact, all the goals that of production that PDVSA had in 2005 not only were not fulfilled by 2012, but actually they all went in the wrong direction. Production went down, whereas it was supposed to be almost twice what it is. And as you can expect, the forecast of most sort of international entities are that PDVSA is very unlikely to get back about 3 million barrels before 2020, and even then nobody seems to believe that the country can, go fulfill any of its investment plan even in like 2035. And if you see the mix in terms of production, you will see that the production is basically concentrated, has been more concentrated in the joint ventures, because those are the only ones who have slightly increased production, whereas the production wholly operated by PDVSA with no partners has had an even more significant decline than the total production. This despite the fact that PDVSA has some very good partners in different projects, including companies like Chevron, Total, Statoil, or ENI, and national companies like CNPC or Rosneft. But these joint ventures, most of the new joint ventures have not significantly increased investment. So everything that was planned has not, most of the plans that have been made in terms of new projects have not happened. So there is a new reality that started even before the decline in the price of oil, which is a reality of more pragmatism. You can call it desperation, but the Maduro administration is trying to, get some investment back in the joint ventures, and they have done a lot of the things that the partners wanted them to do, like reducing the windfall tax and waiving the windfall tax for new projects in the Orinoco Belt, promising more operational and project execution control to the partners, giving cash flow control to the partners of the joint ventures in order to for them to give loans to some of the joint venture projects, and that started with Chevron and Petroboscan and has been followed by other projects. And so that's you could say a trend that allows for some actually cash flow from these projects to actually go back into real investment, and that is a source of some of the increases in production that we have seen in the JVs. Then there is, of course, the issue of the exchange rate, that they have been looking at ways at how to avoid this tremendous overvaluation in terms of the impact that it may have on investment from the private companies. They have the PDVSA and the government have been reducing the PetroCaribe subsidies, and they have announced already many times that they will reduce the domestic subsidies. So you see a lot of moves towards a much more pragmatic approach, and much more recently we see the really pragmatic move to focus on oil blending instead of the idea of pursuing the upgraders that were part of the Carabobo and Junin projects. But still, it has been difficult to get the necessary investments because PDVSA faces problems of cash flow, infrastructure, operational issues, human resources. Now those issues are even worse because of the decline in the price of oil. Of course, macro economic and political instability. Now we have, the perception that Venezuela is going to default in its debt, and that's another, potential big problem. There is, of course, the issue of credibility that I already mentioned. So even though we have these significant announcements of loans to some of the projects, and we know that some of them are actually, happening, as I said, of Chevron and Petroboscan, it would be really hard to finance the development of these projects because of the PDVSA cash flow problems. And then you have the issue of Citgo, of course, that we can talk in the questions, but basically, if PDVSA sells Citgo, that will be problematic for the future because of the lack of access to markets in the competition for markets with the Canadians. But that apparently is what is, in discussion, selling those assets. So to conclude, we see a lot more pragmatisms that might lead to some increase in investment, but production is unlikely to increase because, conventional production is declining and investment will not flow as rapidly as one would like. The production basket of Venezuela is getting much heavier, and that means that it's getting less profitable. So for a given level of price of oil, the cash flow of PDVSA will be smaller. Still, it's important to understand that the break-even of most Venezuelan production is well below the current prices, so it's not as if the government, I mean, as if the projects cannot be economic at the current prices. Of course, the fiscal conditions might have to be more flexible for them to be viable. And we will see a significant an increase in imports of light oil and refined products, particularly for blending, and because that's the strategy that they will pursue in this pragmatic, realist situation. And of course, I already mentioned there are some significant inhibitors of investment that will make this very difficult. So with that, I think we can open it to questions.
Wonderful. Thank you so much. Francisco, that was a great overview, and I shouldn't be surprised it was so negative, but there was a little positive tone in the end there. It doesn't look like everything's over. But look, I'd love to get to questions as soon as possible. I just want to remind people, I've had a lot of questions asking about slides. The slides will be available, so will the recording of this discussion. So we will send all the participants a link with this in the next couple of days as soon as we get it up on our website. So don't worry about taking too many notes. And for those who joined a little late, I just want to remind you on the right-hand side of the page, there is a chat function and a little question mark next to it. If you could put your question over there, and I'll put it on the screen. Please keep it as short as possible. Otherwise, it can be a bit difficult to see it on the screen. So look, Francisco, I'm just going to start with the first question here. Let's get straight into the discussion. Thank you for keeping it so succinct. We have a full half hour for discussion here. But here's the question. How difficult is life for PDVSA's foreign partners in the country? Have things gotten a little easier?
Yes. Okay. Well, as I mentioned, there is a mix between, the pragmatism that came from before the decline in the price of oil, but of course is going to accelerate now, is creating sort of a better negotiation relationship between PDVSA and the companies. PDVSA knows they need them more than ever, and as a result, you see, basically PDVSA sitting with the partners and saying, tell me what we need to do for you to be able to invest. And so in that sense, pragmatism is a condition that really opens the opportunity for doing some deals in a variety of ways. However, of course, the fact that the cash flow problems of PDVSA since since the decline in the price of oil have dramatically increased, these will create very significant problems, because according to the projects, PDVSA has 60% of the equity in most projects, in others even more. And so of the total investment that has to be done to fulfill these plans, PDVSA is supposed to have about 80% of the investment, and even though they could try to finance, and they will ask the partners to help them finance them, it's a very significant obstacle. I would say that one of the big limitations is the lack of cash flow, and of course there are other difficulties like lack of human resources, and of course the macro situation in the country, the difficult situation in terms of scarcity of goods and security issues. So there are other issues, but that's the main one.
Okay. This one's sort of just a little follow-up. Is there any indication that we're going to see a modification of regulation to perhaps facilitate some of these foreign investments?
I think, I don't think at this point we can think about sort of big changes in the law, or or the participation of PDVSA to be a minority partner or something like that. But we are seeing a lot of flexibility. First, we saw this with the contracts like the one signed with Chevron and others, that basically gave them control over the cash flow, and in fact, created a structure by which the exports of the project go to a designated customers that send the payment to a trustee, and the trustee gives back the royalty to PDVSA, to the government of Venezuela, and then, the Chevron is repaid its loan and its dividends, etc. So this has shown that they have been willing to change regulations, similarly with the windfall tax and other things. Now, I think we see some signs that they are willing to, either renegotiate the contracts for the Orinoco Belt projects to make them more, to allow for more flexibility to do to move them to a blending projects more permanently, or a de facto sort of deal to do that. But clearly, that is also that seems to be happening.
Okay. I have a couple of questions here about break-even prices and operating expenses. And so let me just put the first one up here, saying, you say that it's lower than the current price, but what about, does that include a consideration of all the royalties, taxes, capex, and various other external impacts in terms of it still being economically viable?
Sure. We have to consider here a variety of different sort of break-evens, right? The first one, of course, there is the break-even of the existing production and sort of conventional production, which are much lower than current prices. Then, if you consider for the new projects, say in the Orinoco Belt, if you consider the break-even for blending, it's even though it's much higher because you have to blend, say, with 20% of Algerian light oil or something like that in order to be able to export, you still get, clearly below $25 to $30. So there is a lot of room on that. Of course, if you start adding, 33% royalties, taxes, etc., it might become sort of closer to the current price, but there is some room to sort of negotiate the fiscal conditions and make these projects viable. If you are looking at if we include issues like domestic subsidies, Petrocaribe, etc., we are talking about the break-evens of PDVSA as a whole, and which is of course different from the break-even of a particular project. And there you still get, much lower levels than the price of oil today. But yes, the domestic subsidy and the Petrocaribe subsidy make it really hard for PDVSA. It take a significant part of PDVSA's profits from its production. But still, if you're considering sort of a break-even of PDVSA, I think it's at levels clearly lower than the prices that we have before. That's not the point. The point is the break-even of the Venezuelan government, which is the problem, which is, we know it's significantly above the current level of prices. And as a result, there has to be a very significant macro adjustment in order to make it to make the government viable. But as far as PDVSA, there is of course some room. The problem is, of course, that the government will take all the money that they can from PDVSA.
Indeed. I just wanted to sort of ask a question that someone here is asking a little bit about Petrocaribe, and I'm going to put the question up here, but I want to expand it a little bit. So the question is about, Caribbean countries purchasing from elsewhere because of depressed oil shipments from PDVSA. And I was wondering if you could maybe comment a little more broadly on how you see this bigger picture affecting Petrocaribe.
The reports that I have seen is that yes, there has been a reduction in the shipments of, on average, to both Cuba and Petrocaribe, and I think this will continue to happen. I don't think that they will dramatically reduce the shipments to Cuba, but I think that the Petrocaribe tendency will have to be a significant decline. And of course, you probably heard that they are also trying to securitize or sell the debt. First with the Dominican Republic, probably then with Jamaica, And so I do think that this is a trend that after these deals are done is going to continue happening. There is, I mean, before the collapse in the price of oil, all those things had to be done. Now it's not a matter of wanting to them. I mean, they simply there's no other way around them. And so I only expect the Cuba relation to continue in any meaningful way, in the future.
Jeremy, did you have a question?
Yeah, no, thank you, and Francisco, thank you so much. So much information. As Alexis noted, it's probably more negative than we, not that we expect. Obviously, the news is negative, but I want to step back a little bit and talk in hemispheric terms, because you made an interesting point about there's only two countries in our region, in our hemisphere, who've seen declining production over the last 10, 15 years, and that's Venezuela. And the other you mentioned is Mexico. Well, Mexico, for all of those online here, I'm sure we've all seen the news. It was just about a year ago that they put to Congress major energy reforms and overhaul. So I want you to talk a little about what's going on in Venezuela, but when you talk to folks there, and what is your take? I'd be very interested in hearing what the energy reform, now that we're moving finally in Mexico towards bidding in opportunities that are going to be significant investment opportunities for companies, many of whom are the same players that are in Venezuela. What does that mean for policymakers in Venezuela? What have you heard? And let me put another little wrinkle here as we step back and look at it more hemispherically. What does the U.S. revolution, but not just that, but now what I think is going to be an increased focus on this crude oil export question, what do those things mean, and are they getting into the minds of folks in Caracas, and will it have any impact?
I mean, I cannot. I haven't talked recently to people in PDVSA, but I can tell you that I think they should be really worried about a few trends, including, of course, the opening of the oil sector in Mexico. It used to be, that 5 years ago, Venezuela believed that by simply offering access to their reserves in the Orinoco Belt, there was no way that these big companies would not be investing in Venezuela. They slowly came to the understanding that the conditions, particularly after the expropriation process and the problems of PDVSA and the lack of willingness of the government to execute the projects the way that the companies wanted them to have control over the execution, that they started to realize that this was not going to happen. Now, we face a very different environment, one in which the Mexicans are opening with a with an approach very similar to the one of Brazil and Colombia in terms of creating an institutional and regulatory environment that is very attractive, that is very sound in terms of generating credibility in terms of the long term, and of course, the Mexicans have some big advantages in the sense that they are next to the U.S. and geologically are very similar to in the area of the deep offshore of the Gulf of Mexico, and similarly in the Eagle Ford unconventionals. And of course, with the lower prices that we have today, it might be that some of the Mexican potential is not going to start very soon, but I think it constitutes a very significant competition for Venezuela in terms of both investment, but then it will represent also a competition in terms of production with the market that is remaining in the U.S., in which Venezuela, I mean, the shale revolution, as you know, has not been has been a big problem for Venezuela in terms of the decline in the overall price of oil, but it's not it's not the light oil from shale is not the one taking the Venezuelan market. It's actually the Canadian heavy oil, the one that is actually basically taking the market share of Venezuela and, in fact, of Mexico and Colombia in the U.S. market, and is, I think, the biggest challenge for Venezuela in the future, and that's one of the reasons why Citgo is so is strategic for Venezuela. And I do think that they realize that this competition from Mexico is relevant. However, they are so in the middle of so many emergency urgent issues that the more pressing issues are how to obtain the cash flow, how to get back production back up, and so this pragmatism is only mildly related to the Mexican situation. Is much more related to their own dynamics inside Venezuela.
Interesting. Everybody, please keep your questions coming. I was wondering if I could, I'm going to pull together a couple of questions here and sort of ask something hemispheric following on with what Jeremy asked, if you don't mind, Francisco. Taking all of those sorts of trends into account, the lowering of oil prices globally, opening of Mexico, U.S. revolution, problems in Venezuela, who do you think, who is likely to be the winners and losers in our hemisphere? At least in the short to medium term, as a result of these trends, who's going to win and who's going to lose out?
Well, the problem in Latin America is that we have a spectacular resource base. Of course, Venezuela is the more extreme case, but if you look at also the case of Mexico or Argentina, you see tremendous geological potential. But you also see that Latin America, with the exception of Colombia and maybe to some extent Brazil, but not really Brazil, has been a region in which property rights in the oil sector have systematically been challenged and sort of a variety of ways in which companies have been expropriated, and these have not been sustained in the long term. So that even though we have a higher geological potential even than the U.S. in the region, we are unlikely to see anything like it, even though the marginal cost of production in the U.S. are much higher, because the conditions in terms of property rights and taxation in the U.S. and the formidable service industry in the U.S., etc., provide for an environment that it's very unlikely to ever happen in the region. So depending on the price of oil, of course, the challenges for the region could be very significant. Brazil has very high marginal cost in the this total cost or break-even cost in the pre-salt. Mexico is opening areas like deep offshore and shale that are also relatively high break-even. And so if the price of oil is at a level below $60 for a significant period, that might reduce some of the investments in the region, because even though companies plan for the long term, they don't plan with the price of oil today. Still the budgets that they allocate will be will dry up a little bit, and they will have to decide where to put that money, and most likely exploration it's first cut, because you usually don't stop development of fields that are already significantly developed. So that might, for a country such as Mexico or a country such as Brazil, which is attracting new investment for exploration, or Colombia, that might be a problem. Of course, Venezuela is the biggest loser in terms of the decline in the price of oil, because it's the country more dependent and with highest sort of fiscal break-even, etc. But also countries like Ecuador and Bolivia and Mexico are affected in terms of the fiscal, in terms of their budgets, because they are also heavily dependent on oil, although of course much less than Venezuela.
Mm-hmm. So let me ask a really basic question I've got here. Well, maybe not so basic. Maybe it's not that easy after all. Are you expecting an oil price rebound for 2015, or what I would say, when do you expect, and where do you think prices will stabilize?
Well, the price question, of course, is one that we should typically not even try to answer. But there are so many uncertainties. I mean, I think that what we are going to test is the sort of the new elasticity of supply of oil in the shale producing areas. According to the best data that I have seen, very little production, very few production wells are going to be uneconomical because of the decline to say $70. So it is unlikely that a decline in supply in the U.S. Will sustain an increase in the price of oil anytime soon, unless, of course, but moreover, we have to keep in mind that we have a lot of spare capacity, either in voluntary, like in Saudi Arabia, or non-voluntary, like in Libya or Iran, or the lack of. I mean, Iraq until recently was, producing much less than its potential. So we have a situation in which the necessary decline in supply it's not going to come anytime soon, unless either there is a major geopolitical event or Saudi Arabia reaches a point in which they believe that the price is too low for the sort of the consequences, for the geopolitical consequences in the region. Not I think for themselves. They have a lot of room to maneuver, and the Saudis can wait, I think, a couple of years. But the thing is that shale apparently is not going to be, shale production is not going to be significantly reduced, and so that's why I don't see a significant rebound, but we might see some slight rebound.
Interesting. Yeah, I did have a question here about Saudi Arabia, but perhaps we could come back to that at the end. Look, I've had a couple of questions about. I'll just ask this verbally. It's not very often that we get someone who's so knowledgeable about what's actually going on in Venezuela, and I've had quite a few questions about changes at the top. Are we likely to see any changes in PDVSA president? Any changes in the oil ministry? Do we see any sort of political changes, and will that make any difference?
Well, I mean, the new president of PDVSA, Eulogio del Pino, is one of the most knowledgeable oil people in the company, and well trained and with experience. But he has been the vice president of PDVSA Exploration and Production for a while. So the news of his appointment as president of PDVSA in the past, I think, would have been very well. Received by the partners, but today, they have been working with him for a long time, and he has not been able to deliver. So I think their expectations are not necessarily that there's going to be too many changes, particularly because it's out of his hands in terms of all the implications of how does he get PDVSA to have a better cash flow under the circumstances that we have now. It's a very difficult proposition. We knew at some point that there was Del Pino was the candidate of Ramirez, but there was the president of Silgo, Martinez, who also was a candidate to be the president of PDVSA, and there were some rumors about his potential appointment. So in the end, I think Del Pino has much more experience because he was running exploration and production, and so in that sense, it's someone who can sort of deliver quicker, both in terms of negotiation with companies and in terms of knowing the plans that they were executing. On the other hand, from time to time you hear rumors about the military have always wanted to run PDVSA. And the military have become much more powerful during the Maduro administration, and this is one of the few areas of power that they do not control. Something in that balance of power might change, and we could see some changes in the future. But at this point, I don't see any reason why we will see a change in the head of PDVSA. I think the best bet that Maduro can make is to try to, give some time for this new pragmatism to deliver some results.
Interesting. So, people, please keep your questions coming. I've been trying to meld them together as much as possible so that we have as much time for different discussions. So we still have a few minutes if people would like to ask some more questions. I know we have a lot of journalists online, so I wouldn't be surprised if you have more questions. I was wondering if we could just pull out again to have a little bit of a discussion. I had a couple of questions about Saudi Arabia, about OPEC. And I was wondering maybe you could talk a little bit about how long do you think this situation, you said the Saudis can hold out for a couple of years, but what does this say about perhaps the influence as well of OPEC and Venezuela's place in it?
I mean, the problem, of course, for OPEC is that you had the weakening of the power of OPEC in the 80s, in this late 70s, but particularly in the 80s, basically for two reasons. In the demand, on the demand side, oil was displaced from electricity production, and the increasing efficiency sort of reduced for a while the demand or the growth of the demand of oil. And on the other hand, you had the North Sea being a formidable competitor to OPEC production. So OPEC lost market share with the North Sea. And now we're seeing something very similar, this time with the shale revolution in the U.S. The difference, I think, is that I think there is a significant debate about how long does the shale boom going to last. I mean, some people believe that between 2020 and 2030, you will see a peak in shale production, and then again the U.S. will have a declining production, and so we could go back to sort of a bigger role for the low-cost producers in the Gulf. But I think the OPEC countries let the price of oil go too high for too long, and now they face a formidable competition. I mean, costs in shale production have been declining. There is discussion about how much the geological knowledge of shale will, because they already have exploited some of the sweet spots, so we don't know exactly how long these declines in cost could keep coming. But it's really astonishing what we have been seeing, and so really, the reports that OPEC made saying that at about $90, some of the shale will go out. Then they said about $75. I think from what we see now in the data in the U.S., actually the break-evens are much lower than that. And the U.S. government basically, in terms of taxes, it's subsidizing oil production, so they have some room to sustain production even at relatively low levels. Of course, at some point they will start to invest less, and some of the increase in shale will, the rate of increase of shale, I'm pretty sure that will slow down, but we don't know if it will start to decline as much as the Saudis need them to in order to reduce overproduction.
Mm-hmm. Great. Well, let's sort of get back to a couple of Venezuela-specific questions to sort of tie this off. Then I've been avoiding some of the more political questions here, just to make sure we got all the discussion of the energy out of the way first. But I was wondering, what oil production do you expect for 2015 in Venezuela?
Well, I mean, everyone has a different expectation about the current production, but I think it will be pretty close to what we have today, which is, I think, around 2.6, 2.7 million barrels. I think we are unlikely to see a relevant increase in production, but I think that we are starting to see some increase in production in some of the JVs and a little bit on the new Orinoco Belt projects. How much is this going to offset the very worrisome decline in El Furrial and in other conventional projects? I'm not sure. So because of course you need to consider the decline that we had, the rate of decline that we had before it has accelerated with the decline of the fields in northern Monagas, and so I'm not sure how much the new production can compensate this decline.
Mm-hmm. Great. Well, thank you so much, Francisco. That was wonderful, and the discussion was fantastic. If people have other questions, I'm sure you can get in touch with Francisco at Harvard and pick his brain a little more. But just to close up, do you have any final comments? Is there anything in your slides that you wish people had asked you about but didn't? Any just some closing remarks? Yeah, Jeremy, please go ahead. You want to add to my?
I've got a hypothetical that you presented, and we all tend to keep talking about Petrocaribe and how it can't go on and it will have to end. Well, my question for you is hypothetical, but let's say Petrocaribe ended tomorrow. Does it have a material impact on the situation?
I mean, Petrocaribe at this point, since they already have cut a little bit, I mean, the problem is that, I mean, the subsidized part of Petrocaribe outside of Cuba is about 70,000 barrels of oil per day. It's not that much at this level of oil prices. So even with the decline, I mean, before the collapse in the price of oil, these measures like cutting Petrocaribe and, getting some of the securitize some of the receivables, that kind of thing might have been, enough to provide some breathing room for the government. But I think at this point, this is too little, too late, and reducing the domestic consumption will be another big one. There are a few good news coming in that. For example, the fact that the Perla project, in the natural gas project, is probably going to allow for some substitution of natural gas in the production of electricity instead of burning liquids like they are doing now. But I see only small things around the margins and nothing big enough to to sort of save the day.
Excellent. Thank you. No, thank you so much, Francisco. We could go on forever. This is it's just such fascinating. Unfortunately, there's way too much material here, which I don't think is good news for Venezuela.
Yes. I wanted just to make I see some questions on the politics, and I think, I mean, the difficulty of Venezuela next year is that you have, elections for the first time in a situation in which the government is clearly a minority, and so the pressures towards the need of cash from the government for this political purpose, combined with the payment of the external debt and the like, will make for a tremendously difficult choice for the government, and I'm afraid we will see things getting much worse before they get any better.
Oh, thank you for that positive note to end on, Francisco. No, that was wonderful, and thank you everybody for tuning in. You'll see on our final slide here that you've been looking at for the last 20 minutes. We've got a lot of upcoming programs. Please get in touch with us. Join us in La Jolla for our energy conference in May, or join us in Santo Domingo or in St. Thomas. And please, we'll have a lot of other things coming up. We'll be sending you the slides and the recording. If you're interested in becoming a sponsor, please contact Jeremy, Jeremy at iamericas.org, or me, Alexis at iamericas.org. Follow us on Twitter. Check out our energy program. We have lots of podcasts and webinars and reports. And a big thank you to Francisco Monaldi for taking the time to share with us his perspective. It's so rare that we get someone so knowledgeable in Venezuela. Thank you very much.
Thanks for the invitation. It's a pleasure.
Thank you, Francisco. Wonderful. Look forward to keeping in touch, and hope the winter's not too harsh up there in Dean Valley.
Okay, thank you.